PairTrade Finder team here. Have you ever wondered whether there's a better way to trade pairs than just an entry at 2.0 stretch and an exit at 0.0 standard deviation stretch? Well, in this video we're going to take you through the layers function of PairTrade Finder Pro version 138 and how you can use that to boost your reward risk on a lot of the pairs that you trade. So quickly, let's take a look at a pair we've loaded up here as an example, Equifax Navient. And this one has been done, this back test, on a 2 entry at 10,000 a leg with a 0 exit stretch and 100 days, all the look backs, maximum days in trade 100 days, 0.25% commissions, and let's see what the results look like. Well, it's not a bad pair. Over 2 years there were 5 trades. Correlation a bit low, 43.5, co-integrated 0.91. You had a compound annual growth rate of 17.6, a max drawdown of about 16, a high profit factor. You made about 4,300 gross, paid about 12% of that, 13% of that in commissions, and left yourself with about 3,800 or about 766 average net profit per trade. And 80% of them were winners, and on average they took 30 days to complete the trades. And here's your equity curve. It's okay, it's not bad, you know, it's what we'd like to see. However, what we don't like is this max drawdown. Basically, this is a 1-to-1 reward risk. And when we're looking for pairs to put into a portfolio, we want to always try and find a positive reward risk ratio, say 2-to-1 or at least 1.5-to-1. The other thing is the average days in trade, this one is over 30. And we want to use our capital efficiently. We don't want to be sitting in the market for too long. We want to try and find ones with the shortest possible average days in trade. So what could you do to try and improve this situation? Well, what we could do, when we go into group settings, is change how we trade the layers. So if we take layer 1, which is at the 2 standard deviations, let's say we only trade 5,000 on that layer. And let's add another layer at, say, 2.5 standard deviations. And let's trade, say, 3,000 on that layer, okay? And then let's add another layer at even further width, let's say 2.75 standard deviation, and let's add 2,000 to that leg. So you've got 3 different layers now at 2, 2.5, and 2.75 standard deviations, and the total is 10,000 a leg, but you're scaling into these trades as and when the spread widens even further than the 2 times. We're going to change the exit stretch as well, because if you're all the way over at 2.75 to try and ride 2.75 standard deviations and have the trade close, that's pretty aggressive. So we're going to take this to 0.50, which means that on average of your 10 grand, were you to layer into all 3, you're probably in at about 2.6 on average, maybe, or 2.4 on average. So we're going to bring this into 0.5. Now, what happens if we change those and rerun the back test? Remember, you've got a CAGR of 17, a max drawdown of 16. You're paying about 12% in commissions, and 766 average net profit, 80% winners, 30 days in trades. Well, if we run the new back test, what do we find? We find we have our compound annual growth rate has gone from 17 to 19. Our max drawdown has gone from 16 down to 10. Our profit factor has gone infinite because we have 100% winners. Okay, our gross profit's gone up. Our commissions have gone down. So we're up to 826 per trade, and we're still on 5 trades, 5 exits. Okay, that's how we count trades, as number of exits, though we've scaled in, so there's more entries than 5. And importantly, our average days in trade are down to 19, so we're much more efficiently deploying the capital. That's very important on a portfolio management basis. Okay, so this pair looks much, much better when we've used this layering strategy in order to trade it. So let me save this to the watch list, and then we're going to take a look at that from a pair charts basis, just so that you understand why that's happening. It's kind of important that in your mind you can understand why these things are going on the way they are. So if we take this pair, what you can see is that when there's a big dislocation over a number of days, we had way back here in, this is about a year and a half ago, we had an entry at 2.15, another one at 3.49 negative, another one at 4.09 negative. Okay, let's take a look at that in the trade history tab. So this was the second trade. So there's the first one, 541. This is the second one. First layer, second layer, third layer. These are the three entries at negative 2.15, negative 4.09, negative 3.49. And that's because it will only trigger a layer once each day, because we trade on the close on a backtest basis. So when it closed at negative 2.15, first layer went on. When it closed at negative 4, it triggered the second layer because it was above 2.5. And then when it closed the next day at negative 3.49, it triggered the third layer because it was above 2.75. So those are the three entries. And then the trade came good. So you made a boatload of money, 1,732. But the reason this is interesting is, let's say instead of doing this, let's say it had come up to here and then turned around and went away. You know, this, let's say it did, you know, trend back down. Let's say instead of hitting 0.0 or 0.5 where it exited, let's say it turned back around. If you'd entered here with 10 grand and the ratio turned back around to here, you'd have a massive loss. Whereas if you'd entered like this, these three, and the ratio turned back around to here, you might even be break even or even in a slight profit. And you know, when your max days in trade came out, you might end up with a slight profit as opposed to a massive loss for having done one leg at 2.0. And that's kind of the reason why we're seeing a lot of risk mitigation through using the layers. You're not putting all your capital in it too, you're scaling it in, and then you have one exit at 0.5 in this case. So that's why it tends to work. It doesn't work on all pairs, but you know, you can check this out with each pair and figure out what's the best set of settings for each pair. Now, importantly, I want to show you another feature that we've added into the new version 138, which we think is pretty great. It makes the program a lot more user-friendly and gives us the ability to trade previous signals much more quickly. This is taking a long time because I have a massive watch list on right now. So let's go to the trade, the last trade where it's scaled in, which is, so we have EFX Navi layers example. All right. So on 25th of October 2018, layer 1 went in. The next day, layer 2, and then 2 days after that, or 3 days after that, layer 3 triggered in. Now, as you can see, the signals have been called at, were we to resend this to market, that's 5,000 a leg, okay? The second layer came in at 3,000 a leg. This is automatically all calculated. And then the next layer came in at 2,000 a leg. So Pro is calculating the exact number of shares at the market prices for each of those legs based on the different principal sizes that you have put into the leg values when you created the group. And so importantly, let's say you come a day late or 2 days late and you'd seen that there are these signals to enter in to this trade. Well, the new resend at market function makes it so easy. You just click this. You could see that the ratio at the trigger was 1.058. The current ratio is 0.930. Now, this is a long time ago, right? But let's say it was the next day. You can tell whether you're good or you're better or worse than when the actual signal was called. And this is creating a pair trade order type, which is limit on the short, sells 172 shares at 1162, and then market on the long, okay, around 17 shares of EFX. So let's say the market's not open, but my trader workstation is. So let's say I sent this trade, okay? What happens? In trader workstation, let's go here. In the API, oh, there was another trade here already there. So let's go back and let's delete this. Let's delete these trades, which is important. So now we have a clear API screen. Let's go back here. And so again, let me retry that. So you've got a trade. You want to resend it to Interactive Brokers. You just say resend at market. It's taking the latest close prices, gives you the ratio differences, and then you just say send trade to your IB API. And you'll see, boom, it's just come up in the API screen. Navi, it was 172, limit order at 1162, sell. If I hit transmit, it then activates the pair trade order, and as soon as that 100% fills, the rest is sold at market, and you'll see the confirmation when you look into your trade log. It'll pop up right there. So the market's closed right now. That's why we're not seeing prices showing up, and I can't send the trade live, but that's an example of how we do it. Happy trading, everyone.